Welcome to the Deep Dive. We're here to cut through the usual earnings call noise and really get to the insights you can use.
That's the plan.
So today, we're jumping into Chubb Limited's recent Q2 2025 earnings call. They're this massive global insurance player.
Right. And the management team, well, they laid out quite a bit of information. It sounds like a pretty strong story overall.
Definitely. Strong performance, strategic positioning. Our job today is to unpack the key numbers, what management actually said, and, the trends underneath it all.
So you walk away with a clear picture of what's really driving things.
Exactly. From the big growth numbers to some pretty interesting market dynamics, it was packed. Lots for the discerning investor, as they say.
It really seems like their diversified strategy is paying off. You get the sense of a company that's, well, firing on all cylinders, managing a complex world pretty effectively.
Absolutely. Okay, so let's pull back the curtain on the numbers first. These really set the stage for Chubb's quarter. Excellent Q2, hitting record highs on several fronts.
Yeah, what were the headlines?
Core operating earnings per share, a record $6.14. That's up 14% from last year.
14%. Okay, that's solid.
And core operating income, also a record. Came in at $2.5 billion, up 13%.
That kind of growth in insurance, it's definitely notable, but how efficiently are they getting that growth? What about underwriting?
Good question. Underwriting income on a published basis jumped to $1.6 billion. That's a 15% increase.
15%.
And that led to a really strong combined ratio, 85.6.
Okay, 85.6. So for every dollar in premium, they're paying out about 85.5 cents in claims and expenses. That's good.
Better than good. It's more than a full percentage point better than last year. Shows real discipline, right?
Definitely signals strong underwriting. And what about the core business, like ex-cats?
Right. So the current accident year underwriting income, excluding catastrophe losses, that was up almost 11.5%.
Okay.
Which pushed that combined ratio down to 82.3. Nearly a full point improvement there, too.
Correct.
So the underlying business is getting even more profitable.
Very sharp. And investments, always a big piece for insurers.
Yep. Adjusted net investment income hit nearly $1.7 billion, up 8%.
8%, okay.
Operating cash flow, also strong, $3.2 billion.
That's a lot of cash coming in the door.
And here's a key one for shareholders. Tangible book value per share. Stripping out the goodwill and intangibles.
Right, the real net worth.
It grew an impressive 23.7% from a year ago and 8% just since the last quarter.
Wow, 23.7% year-over-year on tangible book. That's significant wealth creation. What's driving that? Is it just the earnings flow through or?
Well, it certainly feeds into it. Their annualized core operating return on tangible equity for the quarter was a very strong 21%.
21% ROE.
And they hit all-time highs and just, overall book value, $69 billion in cash and invested assets, $160 billion. So yeah, the strategy seems to be translating directly into profit, and a bigger, stronger balance sheet gives them options.
Flexibility is key.
Okay, let's get more specific now. Underwriting and premium growth, the core engine. Global P&C premiums, if you exclude agriculture, grew 5.8% or 6.4% in constant dollars. Wow. What's interesting is the split. Commercial lines up 4.2%, but consumer lines grew much faster, 11.9%.
Almost 12% on the consumer side. And what about life insurance? Sometimes that gets overlooked.
Good point. Life insurance premiums were up almost 17.5%.
17.5%. Okay, so that's a real growth engine too. Maybe an underappreciated one. Shows that diversification playing out.
It really does. Now, zooming in on North America, P&C premiums, again, ex-ag, rose 5.3%.
Okay.
And that was heavily driven by personal insurance, up a remarkable 9.1%. Commercial P&C was up 4.1%.
Some personal lines leading the charge in North America?
Yeah. And within commercial, their big middle market division grew premiums 8.4%, P&C specifically up 10%, financial lines up 2%. Even small commercial grew about 10%.
So broad-based growth across different commercial segments too, not just one niche carrying the load.
Exactly. Now, internationally, general insurance ops saw premiums rise 8.5%, but over 10% in constant dollars.
Strong international performance.
Yep. Commercial lines up about 7%, but again, consumer outpaced it, up more than 15%.
15% internationally on consumer. Wow.
And places like Asia, Europe, Latin America, all showing strong double-digit growth in constant currency terms. Speaks to their global footprint, right?
Absolutely. They're clearly finding growth across diverse markets globally.
Huh.
Okay, so that's the premium side. What about the investment portfolio outlook? You mentioned income was up 8%.
Right. So their fixed income portfolio yield is currently 5.1%, and the new money they're putting to work is averaging 5.4%.
So reinvestment rates are higher than the current portfolio yield. That's positive.
It is. And management mentioned that while investment income has sort of flatlined recently, mostly because private equity returns were volatile,
Ah, right. That can swing things around.
they now expect adjusted net investment income to tick up next quarter, somewhere around $1.72 to $1.74 billion.
Okay, so a bit of an increase guided for Q3.
Yeah, benefiting from all that cash flow coming in. And they also talked about the macro picture, expecting maybe higher inflation, a steeper yield curve.
Which, well, maybe not great for the economy overall.
Right. But for an insurer with a huge investment portfolio, higher rates generally mean better returns on that float over time. So they see it supporting continued growth in investment income.
Makes sense. Okay, shifting gears. Capital management, buybacks, dividends, balance sheet strength.
Looks exceptional on the balance sheet front. Very strong. And yes, capital return is happening. In May, the board okayed a new $5 billion share repurchase program.
$5 billion, that's a serious commitment.
Effective July 1st, no expiration date. And in Q2 itself, they returned $1.1 billion to shareholders.
How did that break down?
$388 million in dividends, $676 million in share buybacks. Shows confidence, right?
Definitely signals management thinks the shares are a good value. Any hits to the balance sheet? Acquisitions? Cats?
Well, they did mention the recent acquisition of Liberty Mutual's Thailand P&C business. That caused a small dilution to tangible book value, about 0.5%, or $230 million. Modest, really.
Okay, manageable. And catastrophe losses for the quarter.
Came in at $630 million pre-tax, split roughly 60% U.S., 40% international.
Seems reasonable given the environment. Anything else on the loss side? Prior period development.
Yes, and this is interesting. Favorable prior period development of $319 million.
Favorable by $319 million. So they'd previously set aside more reserves than needed.
Exactly. Mostly in short tail lines like commercial property and personal auto. Those are lines where claims settle relatively quickly.
That's a really strong sign of conservative reserving. Basically finding out past years were even more profitable than they thought. Drops right to the bottom line.
Precisely. Okay, now for the really juicy stuff. Market dynamics and pricing. How are they navigating the competition? Let's start with North America commercial P&C.
Right, this is where the rubber meets the road.
Management said the large account, short tail business, think big property risks, both standard market and E&S.
Excess and surplus lines, yeah. For the trickier risks.
Right. That area has gotten pretty competitive. Lots of capital chasing property deals, pushing prices down, though terms and conditions are apparently hold steady.
Softer pricing, but they're holding the line on coverage details.
Yeah, and crucially, they said they're being disciplined, walking away from business if the price isn't right.
That's key. Not everyone does that. It raises the question of who is writing that business at lower prices.
Good point. But in contrast, middle market and small commercial property, those segments are apparently more disciplined, more orderly. Rates are still going up there.
Really? So a real split depending on the size of the client.
Huge split. Property pricing was down over 12% in large accounts.
12% drop.
But up over 8% in middle market and small commercial.
That's a massive divergence. Shows where the competitive heat really is. What about casualty?
Casualty lines, they said, continue to firm up wherever rates are needed. And Chubb is growing in casualty. North America casualty pricing was up 11.6%, rates up 10.6%.
So strong rate increases in casualty. That's important given loss trends there.
Definitely. Financial lines like D&O, still soft overall, but showing some signs of firming in specific areas.
Okay, a bit of a mixed bag, but casualty is the positive story.
Yeah. Overall commercial P&C pricing, if you exclude financial lines and workers' comp, was up 4.5%. And importantly, loss cost trends in North America commercial seem steady.
Good to hear loss trends aren't accelerating unexpectedly. And the consumer side in North America, you mentioned strong growth earlier.
Outstanding quarter, especially for their high net worth business. Premium growth over 9%, new business up over 17%.
17% new business growth. They're clearly winning share there.
And homeowners pricing was up 10.2%, which they say is ahead of loss costs, running steady at 8.9%. Management expects that strong performance to last.
That's crucial for profitability in that high value segment. Okay, what about internationally? Similar dynamics.
It's a bit different. International retail commercial P&C pricing was only up 0.5%. Financial lines pricing was actually down over 6.5%.
Oof, down 6.5% on financial lines internationally.
Yeah. And similar to North America, large account commercial property, especially out of London, has gotten more competitive. But they said conditions vary elsewhere and are mostly still orderly.
So some international pressure points too, particularly large property again. And reinsurance.
Reinsurance growth was pretty muted, mostly because a big one-off deal from last year didn't repeat.
Ah, a tough comparable.
Right. And again, they stressed they deliberately didn't chase deals where the pricing wasn't good enough. Discipline again.
That theme keeps coming up. Protecting the underwriting margin, even if it means slower top-line growth in certain spots.
Exactly. So with all that detail, what are the big takeaways for you, the listener? First, I think, is the sheer power of Chubb's diversification.
Absolutely. Management kept hammering that home. Geographically diverse customer segments, diverse product lines. It gives them options.
Yeah, they don't have all their eggs in one basket. It supports more stable, long-term growth. They even said roughly 80% of their businesses have good, continued growth prospects.
Even while they're consciously pulling back from bits that aren't attractive right now, that shows strategic focus, not just chasing size.
Right. The second big theme seems to be the durability of that growth. They see areas like U.S. middle market and small commercial as long-term secular trends, not just a temporary cycle.
Secular, not cyclical. That's an important distinction.
And the high net worth personal lines business, after years of fixing prices and models, they expect that strong margin performance to continue.
Makes sense. Plus the international growth, especially in Asia, consumer, digital, auto, A&H, and Latin America, they see that as enduring too, despite bumps in the road regionally.
So a confident outlook on growth sustainability. But how are they handling the big challenges, like social inflation and all the litigation?
Yeah, that's a huge topic for insurers. What did they say?
They spend quite a bit of time on it, called legal costs, inflationary, hitting everything, innovation, business operations, and they threw out a number. $550 billion total cost of litigation, with only a fraction actually going to the injured party.
Stark number. It highlights the inefficiency and cost drag.
And from their perspective, as an insurer, they're responding, tightening up terms and conditions, making clients take on more risk themselves through higher retentions or deductibles.
Shifting risk back to the client where appropriate.
Yeah. They called it navigating a hostile liability environment. We're talking about social inflation, these massive jury awards, nuclear verdicts, broader liability views.
It's pushing up claim costs beyond normal economic inflation.
Exactly. They pointed to middle market commercial auto as a poster child for this problem. And Mashir mentioned how some states, Louisiana, Florida, Georgia, are looking at tort reform, changing liability laws, partly because of these economic impacts.
Interesting that state-level reforms are bubbling up in response. Okay, so they're actively managing that risk. What about the overall commercial margin picture? It sounded complex.
It is nuanced. Headlines might say pricing is below loss trends in some spots, but they clarified. Casualty pricing is ahead of loss costs. Property pricing is negative, yes, but property loss trends are more modest.
Right.
Plus, financial lines are firming up somewhat, and because they're growing more in middle market and small commercial, that changing business mix helps keep the overall North America commercial loss ratio stable.
So portfolio management is key. Shifting the mix towards more profitable segments helps offset pressure elsewhere.
Precisely. And one last point. FEMA and private flood insurance.
Ah, yeah, the National Flood Insurance Program.
They noted its limits are pretty low for the high net worth homes they insure. So the growing private flood market, with better tech and underwriting, is more relevant for them.
Right. Private insurers stepping in where the government program doesn't really fit the need for higher value properties.
They acknowledged phasing out FEMA entirely would be tough socially, but for their specific high net worth book, its impact is limited.
Got it. Okay, that covers a lot of ground.
It does. So now for our favorite part. This is absolutely not financial advice, remember. Just some wild but maybe plausible trade ideas inspired by the call.
Okay, let's hear them. Wild idea number 1.
How about the diversified discipline play?
Intriguing name. What's the trade?
Go long Chubb. And short a basket of, say, regional P&C carriers, focus heavily on property, or maybe smaller specialty insurers known to have big exposure to that competitive large account property market.
Okay, so long Chubb, short the more focused, potentially less disciplined property players.
Exactly. The idea is Chubb is showing the discipline to walk away from bad pricing in large property. Others, maybe smaller or under pressure to grow, might not walk away. They could get squeezed by the price competition.
While Chubb's diversification and strong balance sheet let them pick their spots and weather that specific storm better.
That's the thesis. Chubb thrives due to discipline and breadth. Others suffer margin compression in that softening niche.
Interesting. Focuses right on that management discipline point. Okay, what's idea number 2?
This one's maybe even wilder. The social inflation arbitrage.
Arbitrage. Okay.
Long Chubb again. But this time, short a broad market index, or maybe an ETF heavy in sectors like U.S. trucking, logistics, maybe retail. Especially companies with big self-insured retentions or, maybe less sophisticated insurance programs.
So long Chubb, short companies potentially vulnerable to liability costs.
Right. The thinking is Chubb has spent years actively managing social inflation risk tightening terms, pushing for higher client retentions, understanding the hostile legal environment. They're arguably well positioned.
While companies outside insurance might be less prepared for rising litigation costs and those nuclear verdicts.
Potentially, yes.
Right.
Especially if they self-insure a lot or haven't adjusted their risk transfer strategies. Chubb is navigating this. Others might face unexpected pain. It's playing on Chubb's proactive risk management against potentially underinsured corporate liability exposure elsewhere.
That's definitely thinking outside the box, connecting the dots between Chubb's strategy and broader economic or sector vulnerabilities.
Like we said, wild but plausible.
They certainly highlight how deeply understanding one company's strategy can spark ideas about the whole landscape.
Okay, so let's wrap this up. To recap, Chubb put up a really strong quarter. Record results, disciplined underwriting, strategic growth, pretty much across the board globally.
Management sounded confident. Confident in their positioning, their ability to handle tricky markets like social inflation, and definitely committed to shareholder returns.
Yeah, that focus on durable growth in specific segments, plus the proactive capital management, it paints a pretty compelling picture. Stability, long-term potential.
Seems to be the message.
Definitely. As always, folks, remember this deep dive is just for informational purposes. It is absolutely not financial advice.
Please do your own research.
We really encourage you to take these insights, think about them, and see how Chubb's approach might fit or not fit with your own investment thinking. What stood out to you from this discussion? We'd love to hear your thoughts.